Hey class, how's it going today? I am just going to be talking about Chapter 3 this afternoon. So if you guys have any questions about Chapter 3, always feel free to email me. The title of Chapter 3 today is Securities Markets, where we're going to be discussing the markets for securities. Pretty self-explanatory definition. So I'm going to share the slides with you guys right now, and we'll go from there. So as I mentioned, this is a slide for Chapter 3, Securities Markets. So how firms issue securities, primary versus secondary. Primary market is the IPO market. When you hear about an IPO, that's a reference to the primary market, which is when the company sells its shares on the public market. The secondary market is the trading of shares between investors. So when you buy and sell a stock on any one of your brokerage accounts, like an E-Trade or Robinhood or Fidelity, that's all done through the secondary market. So primary is new issue created or sold, or issue received from proceeds from sale. So the company, why they go public on the primary market is so that they can get more capital to expand their business. Traditionally, that's why you do it. You go public to get more capital to expand your business. On secondary, the current owner sells to another party. The issuer doesn't receive any money from the subsequent rise. So if you have an IPO and then after the IPO, the company, the stock goes up 50%, that actually doesn't benefit the company until they actually issue more stock onto the market. When you're an investment banker, your job is to effectively guess the right price. How much should you be selling this stock for on the public markets? Because they basically list it once and then it gets traded in the secondary market. So how firms issue securities, private versus public. You can have private shares, right? Private shares are a little bit more ubiquitous, not ubiquitous, a little bit more non-transparent. So definition, ownership held by a small group of investors in a privately held firm. They can only actually have up to 499 shareholders under current US law. So that actually puts a cap on how many people can kind of contribute equity, be a source of funds. When you're a private company, there's less of an obligation to disclose, meaning you don't have to disclose a lot of information about your company. Even to your investors, you're a little bit more limited. The cost of going public is actually like being transparent about all your financial statements. You have more reporting requirements to the government. So it almost requires a whole team to go public. You can have an unlimited number of shareholders with a publicly traded company, but you are obligated to release financial statements to the public. Publicly traded companies, when you talk about an IPO, which I already mentioned, that stands for initial public offering, it's the first sale of a stock by a formerly private company. Right today, it's September 17th. And yesterday, a company called Snowflake went public. Has nothing to do with snow. It has to do with cloud data. And, they went public at about $120 a share. By the end of the day, they were around $250 a share. As I mentioned in the previous slide, they only benefit from, the IPO price. They don't benefit from the subsequent rise unless they want to sell more stock. At the end of the day, their company is worth more money. The underwriters purchase security from the issuing company and then resell them. So if you're an investment banker, you're underwriting the deal. So sometimes Goldman Sachs will price the security and then sell them on the public market. They're acting in effect as like a broker for a source of funding. Goldman Sachs' value proposition is that they can raise money for your company better than another bank. Right? The prospectus is a description of a firm and the security being issued. It may mention this in the following slide, but anytime you hear about a public company, I would Google what's called their S1. Their S1 gives a very detailed brochure of information about that company. The issuer and underwriter put on a roadshow, meaning they're going out to kind of promote that stock. Why do they believe it's a good investment? Why they are raising capital? They'll promote it, right? So in some sense, you have to be cautious because any one of these roadshows is in some effect a marketing effort, right? But the purpose, book building and pricing, right? Getting a better price for the deal and finding people to invest in it, right? Underpricing it can be common. You would make the case that Snowflake, if it doubled on its first day, it was mispriced. Post initial sales returns an average of 10% or more. Winner's curse problem. So a lot of times an IPO will occur and it will go up 10%. Underpricing though is easier to market. You'll sell out. The last thing a company wants to do is sell shares in the public market and then not have them sell. So you do want all the shares to be sold. So there is a tendency to underprice IPO shares. However, people are aware of this, and it's often hard to actually get access to the shares at IPO price. Most people like you and I are trading even when they have the day of the IPO. We're not getting the IPO price. We're going to get the secondary market price. So even as the shares of Snowflake doubled, most investors did not get to take advantage of that, because as soon as they got released to market, their price shot up immediately to around $250. So there usually is a lead underwriter, which is an investment bank, and then they'll often partner with other investment banks in order to help proliferate that deal. Average first day returns for mostly European IPOs. So for some reason, and I don't have the data behind this, IPOs out of Greece tend to be the most underpriced. That's what I would say about this. That's what it indicates. And IPOs in Russia tend to be the least underpriced, meaning they probably are priced closer to fair value. Average first day returns for non-European IPOs. So we see that in China, in Jordan, and India. IPO prices tend to skyrocket as well. Tremendous degree of underpricing. I'm not sure what's going on with Argentina, but Canada is probably a pretty efficient market. Even the US, right, relative to other countries, we don't underprice our deals by a whole lot. Underprice looks like on average year around 15%. How firms issue securities shelf registration. So this is Rule 415. The security is pre-registered, may be offered at any time within the next 2 years. So if your stock goes up 100% on the first day of trading, the Rule 415 allows you to start selling shares on the public market, fairly immediately after your IPO to take advantage of that higher price. So they don't take advantage of it in the IPO; they get to take advantage of it in subsequent offerings. 24-hour notice. Any or all pre-registered amount must be offered. So this is, it doesn't just happen. They do notify the market that they're doing this. Overall purpose: facilitates low cost of investment. Bring together buyers and sellers at a lower cost. You're trying to raise funds as a company, and there are people who want to invest in you. So this is facilitating a market. It minimizes time to trade and promotes price continuity. Set and update prices of financial assets. You want to know what your entire company is worth. All you have to do is put 5% of your company on the public markets, and you'll get a good idea of what that price is. Market types. This direct search markets. Buyers and sellers locate one another on their own. Obviously that's pretty inefficient. That's a very informational based market. Then there's brokered markets where third parties offer assistance in locating the buyer and seller. That's a more efficient approach. Then there's dealer markets where a third party acts as an intermediate buyer and seller. And then there's auction markets where brokers and dealers trade in one location. Think about that, an auction market like eBay, right? Market order is one of the most common order types. Most times when I'm entering an order for a client, I'm doing a market order, meaning I want to execute at the time I make that purchase. It's executed immediately at the best price. The best price usually is at in between the bid price and the ask price, what a seller is willing to sell it for and what the buyer is willing to pay. And the difference between the bid price and the ask price is called the spread. And that's where some of these brokers and auction houses make their money, is on the spread. Price contingent order. Buyer sell at a specified price. You might set an order like a limit order, which will say, hey, I want to sell this if it hits a certain price, or I want to buy it if it hits a certain price. Market orders. Average market depth. So S&P 500 is the large cap stocks. It's the 500 largest companies in the US, and the Russell 2000 is the 2,000 smallest stocks in the US. What does the difference in depth apply? When you talk about moving the market, if you're buying Apple, listen, you could buy $2 million worth of Apple. You're not going to impact the price. But if you buy $2 million of a tiny drug company, right, you could move the price. Some tiny drug companies are only worth 50 million or $100 million. You could be buying 2% of the entire company by a 2% purchase or a $2 million purchase. Trading mechanisms. So again, dealer market is one in which they trade over the counter. So think about small cap stocks, teeny stocks, penny stocks, things like that. And there's an informal network of broker dealers who negotiate these security sales. Part of this has been overcome by so much technology that when you're making trades, whether it's on the NASDAQ or OTC, you're effectively entering in a ticker symbol and hitting enter, and the trade is executed. Computer link price quotation system for the OTC market. Electronic Communication Network, or ECN, is a computer network that allows direct trading without market makers. So the computers trade with each other. These are not as common, but they're becoming more common due to the internet, right? Which is not new at all anymore. However, sometimes things move slowly because of the way people's jobs are functioned. They kind of reject automation. There's also a specialist market, which makes markets in shares of one or more firms and then maintains that orderly market. So they effectively, a specialist market, the specialist will hold the inventory of the shares, and they'll make sure there's orderly transactions of buyers and sellers. And again, they'll typically make money on the spread, which is a small difference in prices. Timeline of market changes. So Instinet was first established in 1969. Then in 1975, fixed commissions on the New York Stock Exchange were eliminated, which makes it easier and lower cost to trade. And then Congress amends the Securities and Exchange Act to create the National Security Market System. Again, more efficiency, more uniformity in the market to trade among participants. 1994, there was a scandal at NASDAQ. SEC instituted new handling rules of how these stocks are handled. They integrated the ECN quotes into the display, meaning there was more transparency in pricing, right? At one point in time, the only information you had on pricing was what was in the newspaper from the day before. And then the SEC adopted regulation alternative trading systems, giving ECNs the ability to register stock as stock exchanges. In 1997, SEC drops the minimum tick size from 1/8 to 1/16 of a dollar. You can actually trade in smaller increments, right? And that, that also makes the market more efficient. In 2000, the National Association of Dealers splits from NASDAQ, and that's a regulatory body. In 2001, they had a minimum tick size of 1 penny. I mean, to buy and sell shares within 1 penny of each other doesn't sound like an innovation, but at one point they had to be traded in increments of, like 7 cents, right? So to move it down to 1 cent was at the time, a major advance, even though it doesn't seem like that now. We can continue to move forward. The effective spread versus minimum tick sizes. So if you think about the spread, when you allow trades to happen within a penny of each other, that's going to naturally bring down the spread. Meaning, if you can only buy something in 25-cent increments, there's going to be some inefficiency in pricing. But when you can trade that in 1 penny increments, you're going to get pretty precise in terms of what you should be buying and selling that security for. U.S. markets, NASDAQ. There's approximately 3,000 firms in the NASDAQ. The NASDAQ is predominantly really a lot of technology stocks and a very growth-oriented index, meaning you're not going to have stocks like CVS and General Mills in the NASDAQ, typically. The New York Stock Exchange is more core, meaning it's more middle of the road. It's a secondary market where already issued securities are bought and sold. It's the largest stock exchange in the US. Again, when you're using like E-Trade or Fidelity to buy and sell stocks, all these things are behind the scenes, so you don't see them kind of front and center. ECNs, there's also latency, time it takes to accept, process, and deliver a trading order. Market share of trading in the New York Stock Exchange. So we see here the New York Stock Exchange used to control the entire market, but there's a number of exchanges now, and that market for stock exchanges has become more competitive. meaning you have more places to trade your stocks. Algorithmic trading. This is a rule-based system. When you hear about quants or the use of computers to buy and sell securities, often it's done with algorithmic trading. Based on some factor, it will issue a buy. Based on another factor, it issues a sell. And it's really a hands-off approach from a human perspective. High frequency trading is another one. Uses computer programs to make rapid trading decisions in order to compete for very small profits. What high frequency trading does is, it's actually fairly shady, and they've done stuff to limit it. Effectively, the computers are so fast. By the time you hit enter on your keyboard, you hitting enter is communicated faster to another party who can like jack the price up of your stock by a penny in front of you, knowing you've already bought it, and then make a penny profit. And if you can do that like a million times, you can make a good deal of money. But there's been technology implemented to stop that. It's effectively like if someone has a tremendously faster Wi-Fi connection than you do. It's also dark pools. That's where participants can buy and sell large blocks of shares anonymously. Sometimes you don't want other people in the market knowing your moves. So if you can find a dark pool where it's just, someone's looking to buy and someone's looking to sell, and you can trade those anonymously, you don't have to trade it on a public exchange. And these dark pools are usually in large increments, so 10,000 shares at least. And if you're trying to hide that from the market, so someone like Warren Buffett is making a big investment, he might not want the entire market to know his move because he doesn't want the stock to be rising as he's trying to buy it. So he might use a dark pool to kind of try to hide his identity when he's making a purchase. Globalization of the stock market. So there's been a large move, as you guys can imagine, to automating and electronic trading. Current trends will eventually result in 24-hour global markets. Like, why does the stock market close at 4 p.m.? Why can't it run all the time if there's buyers and sellers in the market? The truth is that just between East Coast business hours, that's where the most volume is, and that's where you can get the most price efficiency. And there's a move towards market consolidation, meaning trading firms are partnering up, brokerage houses are partnering up, exchanges are partnering up. The market capitalization of major world stock exchanges. So, if you added up the value of every company on an exchange, the New York Stock Exchange, followed by the NASDAQ, is the largest. And NASDAQ is even higher than what it is listed here, really because of the growth, an increase in price of growth stocks. Trading costs. This is an interesting slide because players like Robinhood have actually drove down the cost of so significantly that most brokerage houses are no longer, charging fees to make trades. So how are they making money? Well, one way they've decided to make money is they used to pay interest on your cash in your stock account. Now they've gotten rid of that for the most part. So instead of charging you fees, they're just not charging any interest, right? The spread is a cost of trading with a dealer. So while fees have been eliminated, people are still making money on the side off of the spread between the buy and sell price. And the bid price is a price at which the dealer will buy from you, and the ask price is a price at which the dealer will sell to you. So the spread is the ask minus the bid price. Combination on some trades, both are paid. Buying on margin. Buying on margin is, I would say, not recommended. It's using debt to buy more securities. If you are successful, you'll be very successful. But the problem with margin is that it cuts both ways. And if you bet wrong and you have margin, you can get wiped out pretty quickly. So when you see someone making some purchases and they're doing really well and they're using margin, right, that can go from quick success to quick failure. The initial margin requirement is how much they'll let you margin. So if you have a 50% margin, that means with $5,000 in cash and stocks, they'll let you buy $7,500 in stocks, right? So you can margin your account by 50%. The minimum percent initial investor equity, 1 minus the initial margin requirement, is the maximum amount the investor can borrow. Equity is the position value minus borrowing plus additional cash. That's your ownership position, right? What you own minus what you owe. There's also maintenance margin. If the value of your stock that you loaned out and that you margined, you took on debt to purchase, starts declining in value, the brokerage account will force you to put more money into the account or force you to sell it, one or the other, because they're not going to take a loss on your security. And that's when you get a margin call, which is a notification that from the broker that you must put up additional funds or have the position liquidated. If equity market value is greater than minimum margin requirement, then the margin call occurs, and that would be at market value minus the amount borrowed over market value. And if that is less than the minimum margin requirement, then you need to bid that up, make deposits to have that be equal or greater. A margin call will occur when the market value is less than borrowed 1/1 minus minimum margin requirement. So, if you take on debt in your account, you always have to make sure you can fund your margin requirements, because sometimes you'll find stocks can go down really quickly and then rebound. Think about how many people might have had margin calls during the middle of the pandemic when the market was at its worst. And if they couldn't afford to make the margin call, then they were forced to sell it at all-time lows instead of highs. Margin trading, initial conditions. So it's just giving us a financial example here. X Corp, stock price is 70, initial margin is 50, maintenance margin is 40%, and they purchased 1,000 shares. So 1,000 shares they bought $35,000 with equity, and they borrowed the other $35,000 to get the 70,000. Stock price falls to 60. What happens? Position value minus borrowing plus additional cash. So margin requirement is 25,000 over 60,000, so 41.67%. How far can the price fall before margin call? And they say the price can go to 58,533 before you have to put in additional money, right? So it can't fall. That $70,000 investment can't fall much more than that 60,000. Otherwise, you're going to have to start adding more money into your account, or deal with a forced sale. With 1,000 shares, the stock price for margin call is 58,333 over 1,000. So it's, if his share price hits $58.33, and which the 23,333 divided by the 5,8,333 equals that 40%. So to restore the initial margin requirement, equity equals half times 58,333. So you need to deposit that initial margin requirement is 29,167. I won't go over this, but this just shows how the returns, positive and negative, can be magnified by margin. And you're also paying interest on this. And this is saying that a year goes by, if you're paying 9% on your margin loan, if the stock does nothing, then you'll lose 9%, close to 1% a month just by holding it. Short sales is when you functionally it's sell shares not owned by the investor but borrowed through the broker and later repurchased to replace the loan. So what does that really even mean? That means short sale is you're basically betting the stock will go down. The mechanics are a little bit wonky to kind of explain and understand, but effectively you are borrowing the shares, giving them to someone else in the idea that the stocks go down before you repurchase. So you're betting that the stock goes down. It's called a short sale. Borrow stock from the broker. You must post margin. Broker sells the stock, deposits the proceeds into the margin account, and then cover or close out the position. You either buy the stock or the broker returns the title of the party which it was borrowed from. But the mechanics are complicated, but the end result is fairly simple. You're betting the stock goes down instead of up. Round trips is another name for a type of short sale. So you have a long position, buy first, sell later, right? And then you have a short position, which is the opposite, sell first, buy later, and that's bearish, right? So, longs are bullish, shorts are bearish. The round trip is a purchase and a sale, right? So you're bullish initially, then the stock goes up, and then you sell it because now you're bearish. Required initial margin is usually 50%. That's more for low price stocks. So low price stocks, meaning if you have a penny stock, the margin can be higher, which means they won't let you borrow as much. You're also liable for any cash flows. So if the stock, it's not a good idea, or it's more challenging to short a dividend paying stock because you're responsible for paying that dividend. The zero uptick rule, I won't focus on that because they've changed that a couple times since 2007. Short sales, maintenance, and margin requirements. So again, I'm not going to focus on the math here, but you need to make sure your account is funded, and if you're using leverage or borrowing, you need to be sure that that leverage and borrowing is sufficient for your risk profile. Otherwise, you could be a situation where you make an investment and then you have to keep on contributing that investment because it didn't go the way you anticipated. Here's another example of the short sale. So you're going to sell 100 shares short, stock price is at 60. So that's going to cost you $6,000. Pledge 50% margin or 3,000. So now there is 9,000 in the margin account. Short sale to equity is the total margin account minus the market value. So example, maintenance margin for a short sale of the stock is a price of 1675 is 30% of the market value. So 30% times the 6,000 is 1,800. You now have 1,200 excess margin. What's the price for the margin call? Again, these are mechanics that are often done for you. So I don't care as much about the math as I do about the theory. But when equity is less than 0.3 times the market value, the total margin account minus the market value, you're going to get a margin call. When market value equals total margin, the market value is 9,000 over 1.330, which the market value is stated there as 6,923. And then the price of the margin call would be $69.23. So that's shorting the stock. So you'll get a margin call shorting the stock if the stock goes up, because that means you're losing money when the stock goes up. If this occurs, equity equals 9,000 minus the 69.23 equals 2077. Equity as a percent of market value is 2077 over 6,923 equals 30%. To restore the initial 50% margin, you need to contribute 1384.50. Some more information about regulation, self-regulation. Everyone would love to be self-regulated, but what happens in self-regulated markets is sometimes bad behavior happens, and then we require regulation. So the Sarbanes-Oxley Act happened as a result of Enron and a couple other companies going bankrupt. There was fraud at these companies, and the fraud was done by employees and ignored by senior executives. So the senior executives claimed ignorance, and the Sarbanes-Oxley Act doesn't allow them to claim ignorance. If they're ignorant, we assume they're willfully ignorant and have them still be responsible. So senior executives actually have to sign off on financial statements personally, and that increases the cost of compliance. So it's more expensive to make sure of that. But it's supposed to be a sign of investor protection. Also insider trading, not a good thing to do. Non-public information about a company possessed by officers, major owners with privileged access to information. If you work at a company, you hear something big is going down, you're not supposed to be able to trade on that. And that is the end of chapter 3, guys. So hopefully that was helpful for you. This is a pretty interesting chapter when it talks about the mechanics, about short selling. Also want to think about why someone might short sell when they're negative on the stock. When you go bullish, you can establish a position in a stock that is simultaneously both short and long at the same time. So it depends on your risk profile, depends on the type of security that you're investing in. But these are things I just find especially interesting about the stock market. So I'll be posting some more commentary to the chat this week. But thank you guys, and hope you had a good class.